right, good morning, everyone, and welcome to another Market Street Live event. Today, we're going to have another educational webinar similar to what we did last month, where we kind of chatted through some equity compensation. But today, we're going to go through the next iteration of that and add an additional layer of complexity for stock options today. We're going to talk through non-qualified stock options and incentive stock options themselves and how they're a little bit different than the equity compensation last week. This is part two of our three-part series on equity compensation as a whole and the ability to kind of have ownership in the company that you are working for. So we'll quickly dive through our typical disclosure itself. None of this is intended to be investment advice. Just a reminder that anything that you think might pertain to your overall portfolio or your financial plan, reach out to your Market Street advisor, and we'll get you squared away in the right spot. We know that this kind of equity compensation doesn't impact everybody, but for those that it does, it can be a pretty fundamental portion of your financial plan. And so we think it's important to understand how this is overall impacted and the implications for what your future ends up being with respect to these options, your wealth, and your eventual retirement themselves. So as a reminder of those that are talking today, I'm Aaron Williams. I'm a partner here at Market Street and a senior financial planner, and I'm joined by Austin Angel, another one of our partners and senior financial planner. And we will be the ones breaking everything down today. As we highlighted earlier, this is part two of our three-part series. We're going to focus on stock options, specifically non-qualified options and ISOs, incentive stock options. Last month, what we had covered was restricted stock. So RSUs, restricted stock units, performance stock units, and then restricted stock as a whole. And so we kind of talked a little bit about those particular events where you are given shares of a company once you get to a vesting date. So once you've been at the company long enough, you put in your hours, you get to that point, they grant you the shares, and as soon as those hit, it's compensation to you. And so what's different about last month, what we kind of talked about is we don't really have necessarily the control side of things. It's one of those situations where the company puts that in place. Usually it's one of two options where you get a percentage every year for 2 to 4 years. More often than not, it's a little bit on the latter end, or like a cliff situation where you get 100% of these restricted stock units that vest at, say, 3 years time. And you get all of those. As soon as the shares become available to you, that's constructive receipt. So 100% of the value is taxable to you at that point in time. And we also took some time last month to kind of highlight the withholding gap. So very often when it comes to options, and we'll see that again today, but it's a little less impactful. With the restricted stock units, the supplemental rate that kind of the federal government mandates must be withheld is 22%. So if you are in a higher tax bracket in the 32, 35, or 37, there can be quite a spread that exists between what taxes are owed on the fair market value of those securities when you own the company, when you're granted those shares, and what you actually end up having to pay in April. And so sometimes that under withholding can lead to penalties, and that's never fun to be able to kind of go through. And so monitoring this and then looking at a tax estimate throughout the year, we think is pertinent. And we'll kind of talk through how the tax situations of non-qualified stock options and incentive stock options differ a little bit today. And the last thing we covered last month, it rings true with non-qualified and ISOs as well, but it's just the idea of concentration risk, right? We have salaries tied to these companies. Part of your retirement, your 401k plan is opened up through the company itself. Oftentimes your health insurance is tied to the company, and then you're adding in a portion of it, not just general bonuses, but a portion of your net worth now is becoming a bigger component to one specific company. And so understanding that level of concentration and how do we start to diversify out of that in a tax smart way is a good thing. So Austin, why don't you kind of break down where we're going to go with today's discussion on stock options?
So just setting the stage here and setting expectations. We're going to cover four main topics. The first, what the heck are stock options? Just from a vocabulary, right? Like, I think to understand these things, you first have to understand the jargon that comes along with them. we'll talk a little bit at a high level, just quickly what the differences between the NQSO and ISOs are. Then we'll do a deeper dive, right? Deep dive on NQSOs, how they work, the mechanics, the tax, and we'll even walk through, just a very basic example with real numbers
Yep,
to show you. I
absolutely.
think that's, for me at least, that's how I learn the best is just
Yeah.
lay it out, show me the numbers.
Yeah, we were just chatting right before this started that going through like our CFP
Yeah.
course itself. It's kind of a refresher on some of those items, and looking at the numbers makes it a lot more
Oh, yeah.
concrete
Yeah.
for us.
I can vividly remember studying for hours and hours and going through these exact examples.
That's exactly it. Yeah, yeah. I'm familiar with that. It's a
Yeah.
pain point. We're glad to be done, but we'll walk through an example slowly just to make sure that everybody
Yeah.
who's watching this, you have a good grasp of what ultimately we're trying to kind of break down and what the overall
Yeah.
understanding is.
And then we'll talk through ISOs, deep dive there. And then, they're very similar. I think the piece we might spend the most time on ISOs is the AMT and just what
Yep.
is alternative minimum tax.
Yep.
And Aaron's very familiar with that, so he can walk us through that.
All right.
All right, so stock options, what are they? At a high level, a stock option is the right, but not the obligation to buy the shares.
Yep.
So with RSUs and what we talked about last month, we kind of called them full value awards,
That's right.
right?
Yeah.
So meaning when they vest and they're given to you, you get all of them, and they're always going to be worth something,
Right.
right? With
Right.
stock options, you have the I don't love using the definition, the name and the definition, but you have the option to purchase the shares.
It's the reason it's there.
Right. And if the shares aren't doing well, or maybe they've actually come down in value since they were given to you, there's a chance they're not worth money.
Yeah, that's one thing that's different when it comes
Hmm.
to stock options versus those full value awards, restricted stock and
Right.
performance awards is they're worth something when they're given to you at
Yeah.
that point in time. Whereas an option, it can expire useless.
Right.
Like it can be at a spot where you just would never technically use the right
Exactly.
to actually exercise what these options are themselves.
Right. So here's some of the definitions, some of that jargon I was alluding to. Strike price. Okay. The strike price is the fixed price at grant.
Okay.
So when you're awarded these, when your companies give you these, they're going to have a purchase price, essentially.
Got it.
So let's say you're given stock of Lilly and it's worth, or at the time it's given, you have the option to buy at $100 a share.
Okay. I'd take that all day long, given where it's
Absolutely,
at right
compared
now.
to where it is right now.
Right.
So that is your strike price. It's the price that you're going to buy it at.
Yep.
Does that make sense?
That makes sense.
Okay.
Okay.
The spread, this is more of a tax IRS term, but the spread is the gap between your strike price, what you're going to buy it at, and what it's worth today out in the actual market. If you were to go buy
Got it.
Lilly out on the market today, I don't even
It was
know.
it was about 956 last week, and
Okay.
so $100 to 96. That's a pretty good spread to be able to
Yeah.
have.
Yeah.
Yeah,
So
yeah.
that would be your spread, the 950 to your $100 strike price. That gap between the two is your spread.
Actually, it might have been over 1,000. It was over 1,000 for a touch last week, so it may very well have
There you
slipped over
go.
that. I've not checked to see what it's trading at this morning at 9:30 since we just got launched.
Exercise. This is I think the key fundamental between the RSUs and these NQSOs and ISOs, these options. Exercise is you acting upon that option to buy. You are now telling the company, telling the government, telling the IRS that I am going to purchase these and exercise that option.
Okay, so that is exercising is what it means for you to pay that
Right.
strike price. So
Exactly.
going back to your example, if you had a Lilly option at $100 a share, you choosing to pay the $100 to get the share that's now worth
Right.
1,050 is going
You're
to cost you the $100. You're
Yep, and you're
exercising.
exercising it.
Okay, so you're
Compared to RSUs or full value awards, there is no exercising because as soon as you vest, you're given them. You're handed that.
that's right. Yeah, and then kind of like what we established last month, way more companies have gone the RSU, the performance awards
Way
route.
more.
It's a lot cleaner from a books perspective
Yeah.
because it's just one transaction date that occurs when they vest and they're given to you. What ended up changing was a handful of years prior to that. I mean, early aughts at this point in time, so it's been a while. The changeover of how companies had to report stock options on their balance sheet versus kind of restricted stock. And so it all kind of shifted completely to where the restricted stock was more of the liability in the
Mhm.
future itself. The options had a bit more of a current liability. And so shifting how the balance sheet was reported is what caused that trend
Yeah.
itself.
Few more definitions here. Expiration date. Okay, again, a difference here between last month's and this month's. Because these are you have the option to buy, there has to be some sort of expiration date. These
Yep.
can't just go out into infinity,
Right.
right?
Yeah. Back when Lily was $100 a
Yeah.
share, it's you're probably beyond that expiration time frame at this point.
Yeah. So oftentimes I think it's very standard for it to be 10 years.
Yep.
Um,
10 is pretty much all that I've ever seen.
yeah.
It tends to pretty much always be right around the 10-year mark.
So if you were granted NQSOs this year, 2026, if you don't make a decision to exercise, you don't actually go in and purchase the shares by 2036, they would expire. There's no benefit. They're
Yeah.
worthless
You
at
don't
that
receive the
point.
value at that point in
Exactly.
time.
In the money, out of the money. This is just, again, a jargony term to basically say, is the fair market value out in the stock market, if you go buy the shares, is it higher than the strike price? If it is, your options are considered in the money. They're
Okay.
worth something,
Yep.
right? Out of the money is the exact opposite. If the fair market value is below your strike or they're worthless, right? You wouldn't want to exercise something you're not going to economically benefit from.
Yep.
That's considered out of the money.
That's right. And when you and I kind of were prepping for this itself, I've kind of highlighted when I walk clients through this example, if it's out of the money, we don't ever use the
Right.
exercise itself. It potentially could expire
Mhm.
worthless. But it's also one of those situations where you may choose to wait, even though it's in the money. You don't want to exercise it right at that point in
Mhm.
time. And so, because you have that 10-year expiration window, if it's in the money and it's 6 months after this was granted to you, you could still
You
technically,
can wait.
as long as you vested,
Yeah.
so there is usually a vesting date that still occurs with these, but as long as vested, you could exercise it. But it's one of those situations if you have conviction that the stock price continues to go, you more often than not will wait until you're closer to the expiration date to allow it to become deeper in the money.
Hmm.
Now, the trade-off that often occurs with that, though, the more you're in the money, the more you're at risk.
Right. Yeah.
And so it becomes a timing game of how much concentration risk do I have and want to just exercise this to take the gains off the
Hmm.
table.
And the other layer too is taxes, right? If we're in a high
Absolutely.
tax year, maybe we want to wait a little longer. If
Yep.
we're close to retirement, or we're going to see, bonuses or RSUs or other comp kind of fall off, then we're going to be in a lower tax year in the future. Maybe we'll delay an exercise then. So
That's
a lot of layers to these options
yeah,
here.
and that can happen with retirement too.
Yeah.
Is one of those situations where we're in high tax brackets in those pre-retirement years, but if the options are not forced to be
Hmm.
exercised and you're still going out from an expiration date into your retirement years, if your income drops quite a bit, then it's really advantageous to look at
Absolutely.
the time to do that.
NQSOs and ISOs, we'll dive deeper into those
Yep.
here in a bit. So, all right, Aaron, do you kind of want to set us up just for, from kind of a logistics standpoint or order of operations, how do these kind of function and then how do they differ from RSUs?
Got it. Yep. So similar lifestyle overall. You have a grant, meaning the company is basically given a contract as to say, we're
Mhm.
giving you these amount of shares, or in this case, we're giving you the option to buy these amount of shares, whereas the full value awards, the restricted stock, and the performance awards, we're assuming certain metrics get hit, those get delivered to you
Yeah.
at vesting. And so, very similar to RSUs, there will be a schedule laid out in that document that'll kind of highlight when are these shares, or in this case, options actually yours. So with RSUs, when they're vested, they are delivered. And so we have kind of this, let's draw out with a laser pointer here. Um, the exercise period is what's a little bit different here compared to RSUs. RSUs, we call that the delivery date. Vesting and delivery, we're basically the
Right.
same thing. Once they were vested, almost all the time it's delivered to you, it's given to you in a brokerage account that becomes taxable to you. You can hold on to the shares at that point in time. You're paying taxes with the RSUs when they're given to you. I have receipt of the shares. After vesting with an option, again, there's nothing that says I've actually got the shares themselves. I just can exercise the option themselves. And so it's actually not taxable. So with RSUs, it's taxable basically upon vest. They're delivered, they're taxed
Mm-hmm.
to me at that point in time. Options upon vest, I now have the choice, the option
Mm-hmm.
to make that purchase, pay the strike price, and then receive the shares. That's what's going to potentially trigger a tax bill to me. And then once that occurs, the eventual future sale
Yep.
is another potential tax event. Hopefully, the shares continue to go up. So what we traded RSUs instead of delivery being I received the shares on the vesting date, I just have the option to purchase the shares on the vesting
Exactly.
date, typically for a lower price, not always the case, whatever the strike price is that's laid out upon grant to me. And then from there, whenever I actually sell the shares, I could have short-term or long-term capital gains. That's really kind of important when it comes to looking at how non-qualified options and ISOs, incentive stock options, kind of differ.
Okay.
And so, and what we'll do a deep dive into both of these here in just a second, but just to kind of set the stage of what's to come with these two discussions. Non-qualified options, the moment I exercise it, that's my tax event.
Okay.
That's my big tax event to occur is when I exercise and I pay the strike price, I receive the value of current fair market value minus what I paid. That's income to me.
Okay. So that spread that we kind of talked about.
Exactly. That spread is income and it's ordinary income. So whether I'm in the 24%, the
Mm-hmm.
32, 35, 37% marginal tax bracket, I'm taxed at those rates. The other side of it is I will still pay FICA taxes on there. If I've not eclipsed the Social Security wage base, I'll still pay Social Security tax. I'll
Yep.
still pay Medicare tax on those dollars. It is just straight ordinary income to me at that point in time.
So from this is kind of a more detailed, nuanced question, but just from a, tax recording perspective,
Yep.
this just flows through your pay stub and flows through W-2?
Yeah,
Okay.
yeah, great question. So you will see this just as a part of your W-2
Okay.
compensation. There will typically be a code or something that'll kind of break out what that amount is. Oftentimes, the W-2 doesn't give you as much information as
Yeah.
you're kind of looking for. And so a pay stub, like a final pay stub, is a lot better to break out because you'll see your typical regular wages, but then you'll see stock compensation
Hmm.
that'll come into play. You'll see that with restricted stock as well. But yes, this income is W-2 income. It's going to show up in box one. And so that's one of the things that kind of keep an eye on because again, the tax withholdings on these isn't always up to snuff.
Right.
And so if that statutory 22% is not high enough and you're in a higher tax bracket, we want to make sure that we're monitoring where the tax is being paid separately and you don't have this large tax event that's going to create a penalty in addition to kind of a surprise come April of the following year. With non-qualified, so because it is all ordinary income and it's reported in the year that you exercise, we don't trigger the alternative minimum tax. I'll get to that in just a second.
Hmm.
The other piece to it is there's no holding requirements themselves. The moment I exercise them, they're my shares. I can sell them. I've already recognized all my income.
Okay.
So let's go back real briefly to our Lilly example. If it's worth 1,050, my strike price was 100. It's gone up $950 at that
Hmm.
point in time. That's income to me. I can turn around and sell it next day.
Sure.
No implications. It's not going to change my overall tax situation. So it is more simple than an ISO, but it's added a little bit more complexity than the RSUs that we talked about
Right.
last month because we have this decision date of when to exercise. Now I have control over when am I going to generate the income versus just when the company's giving the shares to me
Exactly.
at that point in time. Let's contrast that real fast with incentive stock options. So incentive stock options, they're very similar to a non-qualified
Hmm.
in that you're given shares. I'm going to go jump back one slide. You're granted shares.
Yep.
There is a vesting date of when you can exercise them, and then you choose to exercise them. The biggest difference is exercising them is actually not always a taxable event at that point in time
Okay.
because the moment that I exercise those ISOs, I've recognized value, I've gotten the shares, but incentive stock options kind of follow you a little bit longer. And the
Okay.
reason why is there's a couple of different holding periods. You are incentivized, hence the incentive portion of incentive stock options, to actually hold these a little bit longer. So we'll see here in a few moments that there's extra holding periods where if after I've exercised it, if I held it for another year, instead of that full spread
Yep.
being taxed at ordinary income rates, it can be at long-term capital gains rates. And so that can be very meaningful, right?
Okay.
If I'm in the 35% tax bracket, But that 950 increase in the Lilly share that
Yeah.
occurs, if I can get that all taxed at 20
Hmm.
versus 35, that's a huge tax savings for
That's a
me at that point in
ton of
time.
tax savings.
Now, it does mean that I have to hold things a little bit longer. There's a bit more administrative complexity that occurs. And there is this object of alternative minimum tax, which we'll kind of unpack a little more detail itself. But you can kind of see where we highlighted here that you have to satisfy both holding periods, which means once it's granted to me, I have to have held it for 2 years post the grant date and then 1 year post my exercise date
Okay.
before I end up selling all the shares. And if that's the case, then I get long-term capital gains on all of this. And so that's the meaningful difference is basically how long am I holding onto the shares after I've exercised them for an incentive stock option. Okay, so let's kind of do a deep dive, kind of unpacking non-qualified a bit further and kind of walking through an example. So it's a bit more simple of the two, and we'll use that as a building block for what incentive stock options into being. So we've kind of talked about the spread overall. So the spread is where when I go to exercise it, I'm
Yeah.
paying a cost to be able to do so, but the difference between the value on the day that I pay that cost, that's going to be income to me. I'm going to
Right.
report the income. So unpack real fast kind of that particular spread, and then we're going to go through the tax implications and a detailed
Yeah.
example here.
I think you brought up a good thing because we haven't talked about either's, which I'll get to in a second. But yeah, the spread. I think we've hit on it a few times here. So in this example on the screen, you were given 1,000 NQSOs, so 1,000 shares
Mhm.
at a $20 strike.
Yep.
Out in the market right now, that stock is worth $80 a share.
Yes, we're assuming in this case they vested.
They've
So
invested.
you've gotten to that
You
point.
now have the option or the obligation, the right to exercise, to buy these shares at
That's
$20
right.
versus at 80. And so that difference between 80 and 20, 60, that's your taxable event. That's your ordinary income. Flow through your pay stub, flow through your W-2, and it will eventually be taxed at the end of the year on your tax return. Aaron mentioned earlier, oftentimes these are withheld at the statutory 22%.
Right, right.
Most of the time, most people are higher.
That's
These
right.
are oftentimes for more highly compensated individuals, so they're in the 24 plus. So there is that tax surprise tax bomb that can occur with these.
Yep,
The
yep.
other thing I wanted to quickly touch on here, Aaron, that we maybe glazed over but didn't go into enough details. You do have to purchase these. Whereas the RSUs, you're given them these in this example, this is $20 at 1,000 shares. So you would need to come up with $20,000. Now there's different ways to make that happen,
Yep.
but I don't want to miss the point that you do have to pay for these.
That's right. That's right. We've got actually a
Yeah,
slide covering that exact topic here in just a few things, but I think it's a good thing to kind of preempt is the strike price. We kind of talk about it naturally because what we're focused on a lot of times is the taxable income.
right.
It's that spread of $60, but there is still a cost to be able to get to
100%.
all of the shares themselves. And yeah, that's a good kind of precursor to kind of what's to come. So you mentioned there's the tax situation. It's really at the spread. So what's different than RSUs? Nothing happens at vest.
Nothing.
And so there is no tax implication that occurs at that point in time.
Yeah, because from the IRS perspective, you haven't received a benefit yet, right?
Right.
Because you technically don't own the shares until you purchase them. So at grant, nothing happens from
Mhm.
tax perspective. At vesting, nothing happens from a tax perspective. Only at exercise does something happen.
Yep.
That's ordinary income based on the spread, which is your fair market value minus your strike.
Yep.
And then eventually you're going to sell the shares.
Right.
If
And
you
you can sell them right
You
away.
can. If you sell them right away, that's again short-term capital gain, which would
Yep.
be ordinary income. Hopefully the price hasn't moved too much if you're selling it rather quickly. If you hold it for a year, it's considered long-term capital gain. Most of the time that would be 15%, possibly 20% based on your income.
Got it. Got it. Okay. Well, let's kind of unpack a detailed example here of Really just unpacking the spread slide that we had previously.
Yeah, so same exact numbers here. We're using Mike as an example.
Yep.
Mike was given 1,000 NQSOs at $20 strike.
Yep. We're assuming they're vested at this
They're
point.
vested. He now has the option
Got it.
to exercise or to execute on these. So let's say Mike does exercise. He's going to need to come up with $20,000
Yep.
to exercise and buy these shares.
Got it.
They're now worth 80,000, right? 80 times 1,000 shares. That spread, 80 minus 20 is $60,000. That is the reportable income to the IRS. That's what he will pay ordinary income. In this example, he's in the 32% bracket. So he'll pay 32% on that.
Okay. Okay. So it's gonna be another 19,200
It's going to
stuff.
be $19,200, oftentimes only being withheld at 22. So most of that is going to hit in April or
Yep.
later in the year when he goes and files his return.
Got it. Got it.
His cost basis, right? So now thinking we're shifting gears. I own the shares, they're mine. I now decide if I want to hold them or sell them.
Yep.
I now have a new cost basis from a capital gain perspective of 80, right?
Yep.
Because I've paid ordinary income between the spread. Now that bumps up my cost basis to 80. And ultimately, Mike has this decision if he wants to sell right away, short-term capital gains, or hold it for a year and pay long-term capital
Got
gains.
it. So he received $80,000 worth of shares, but it cost him to get to that
Right.
80,000, right? So I think to your point, that's important. The 80,000 kind of breaks down to $80 a share, 80 times the thousand
Hmm.
shares themselves. And so that could be the case where he has all $80,000 worth of shares, but to do that, he's got to come out with a decent amount of
Yeah,
money. He's coming out with $20,000 for his strike price to exercise the options to get
exactly.
the 80,000. Plus, he pays the taxes on that spread. And so it's really of the 80, about 50% of it in this case
Yep.
is actual cash that he has to come up with. So the question we often ask is, how do you come up with that cash,
That's a
right?
great
That's a
question.
huge amount of cash to be able to come up with from a tax perspective to cover it and to exercise the strike themselves. And so there's a couple of different ways that we often kind of see this. And the three we put three most ways because the last one's a very surprising one that doesn't really happen all that often. I've not actually seen it with
I've
any
not
clients in
either.
particular, but it has happened historically. So a cash exercise, I could just say to have the $20,000 in that case to exercise the options for Mike. Mike comes out of cash.
Yep.
He's got a brokerage account separately. He's got money that he's been withholding from his paychecks, knowing that this exercise is coming.
Sure.
He's been setting it aside. He could just write a check and say, I'm executing this. How this really kind of works is, let's say you've got the funds in a brokerage account, is if you've got funds in there, you can just basically tell the custodian that's holding these, whether it's Merrill Lynch, Fidelity, whatever,
Hmm.
you just say, hey, you pull it from the cash that's in my brokerage account. Or if you had other shares in that brokerage account, you can sell a position, bring out the cash bill to do so. You get the most amount of shares that way because you're paying for the option and you're just getting all of the shares
Right.
that you exercised delivered to the brokerage account at that point in time. So it requires the largest cash outlay. It puts a little more concentration risk because now you have more shares overall, but it's the maximum amount of way to hold shares post the exercise. A cashless exercise, and I would say this is probably the most common that we end up
Yeah.
seeing, is we kind of highlighted there's no holding requirement afterwards. And so you could just turn around and say, okay, I've received $80,000 worth of value of my company
Hmm.
stock. I need to cover 20. I tell the broker, sell $20,000 worth of value right out
Yeah.
of the gate. So now I have this 60,000 that's kind of net into my account. And that happens to actually be the spread. That happens to be
Hmm.
the income that I have. I still owe the taxes. So going back one slide, I still owe this 19,200, but I've used some of the shares to basically pay for the rest of them.
Right.
It's what's known as a cashless exercise. It's the most common because, quite frankly, having $20,000 to drop on the exercise is not
Right.
what everybody has available to them. And then the last one that we often see is just kind of the sell to cover itself is you sell enough to now cover the exercising and to cover the taxes too. So going back to our previous example of, okay, Mike needs to come up with 20 grand. He also has to come up with really 22% for the statutory rate, but let's say he covers the whole amount. He has to come up
Okay.
with almost $40,000. A sell to cover will pay the exercise price and it's going
Plus
to
the
cover the
tax.
tax pieces.
Okay.
And so really in that case, let's say that you were able to adjust it and have the broker withhold and cover the
Yeah.
the 39 too. Out of the 80, Mike's really only sitting there with about 41 to
Okay.
about 40,800 that's
So
going to occur.
I think of this from just a pure share retention. How many shares do I want to hold on to?
Yep,
Cash exercise is going to give me the most.
exactly.
Cash list is going to give me the second most.
Yeah, it's kind of the middle ground.
Yep. And sell to cover is going to give me the least.
That's
Is that
exactly
kind of
right.
the way to think
It'll
about it?
give you the most amount of diversification that's
Okay.
going to occur at that point in time because you're selling the most shares because you're covering not just the strike price, but the strike price plus the
Got it.
tax bill that's going to occur. So cashless exercise, this middle one where you're selling some to cover the strike price, you still have to pay the taxes in some way, shape, or
Right.
form. And so planning for that can be important. But you're 100% right. These are kind of in order of how many shares am I going to hold on to post the exercise. The other options of stock swap. So this doesn't happen very often, but let's say that you had RSUs from last year that vested and they're sitting in your account.
Okay.
If I had them and they were at $60 a share from last year, I could, instead of doing this cashless exercise, I could tell the broker basically use these. You're going to basically sell them to cover, you're going to transfer them to cover the strike price. So if it was $60 a share and I've got to cover the 20 grand, we're going to sell just enough. We're going to basically transfer enough back to
Got
the
it.
company in order to cover that. Very plan specific. This is one of those things that I kind of mentioned. I've not seen it very often
Mhm.
recently. But if it does happen, it does allow you to hold on to more of your own cash and allow your basis to now be reset to a higher basis overall. So it can make sense if it's an option. It's just not an option all that often anymore. Okay, so we've kind of talked through the non-qualified options. We have the tax implications of when we exercise it, that's when the taxes are due. ISOs are a little bit different.
Yep.
And the reason why is because we can get better tax treatment. So ISOs, I kind of love them because they give you the best tax treatment out of
Hmm.
all of these equity compensation structures themselves. But we now have extra administrative responsibility of making sure that we're holding it long.
Sure. I feel like this, the IRS and the government loves to, they give you a benefit, they give you an incentive,
Yep,
but with any benefit or incentive, there's rules that you have to follow,
that's exactly right.
right?
Yeah,
Roth IRAs, there's income limitations, like,
holding or years that they have to be
right.
held before you can pull them out.
Every incentivized account or awards in this example comes with its nuances.
Yep. Yeah, I think you're 100% right. That's a great way to kind of frame that
Hmm.
because that's exactly what's happening in this case. It's basically a non-qualified
Yeah,
option, just with a little bit longer holding requirement, but I get rewarded for doing so.
exactly.
And so the difference here is instead of all of the cash being recognized and it all be ordinary income, if I hold it for longer, I get long-term capital gains treatments. For most individuals, that's at 15%. If you have a lot of these kind of options, you might very well be in the
Yeah.
20% capital gains rate. And also, I mean, it's easier if you're married to have a bit of a wider gap before the 20% capital gains rate comes into play. The single individuals can hit that a lot faster. If you don't, a lot of times what I kind of frame here is let's say we don't hold it for both periods. It's basically just a non-qualified option. I,
Yeah.
I just have ordinary income in the year that it occurs. So I just don't get that 15 or 20% capital gains rate. I'm just going to pay it at my ordinary income rate of 24, 32,
Got it.
35, etc. The only difference is ISOs don't have FICA taxes on them. So you actually don't have to pay the Social Security
So,
wage
yeah.
base or the Medicare taxes on that. Now, the additional Medicare, I think, still applies here. And so it's just the regular Medicare tax. The holding period. So once it is granted to you,
Yeah.
when you go to exercise and sell these, it has to be 2 years post the grant date and 1 year from when you exercised it to get the better tax treatment.
Okay. And these are truly two separate systems,
Yep.
meaning if I held it for 3 years post grant, but I didn't exercise,
Yep. I
I
satisfied
still,
one of the two holding
right.
periods,
Even
but
though I
not
held
both.
it for 3 years, I
Yep.
didn't technically exercise it prior to that third year, so I still need to actually hold it post exercise for an additional year.
That's right.
This
That's
is
right.
two separate systems.
Yeah, so I've got to come up with the cash to exercise the option.
Yep.
Same thing, we still have a strike price, so I've got to exercise it. But in your scenario, if in year three, I'm beyond 2 years from grant, I exercise it to get the tax treatment that I want of long term, I have to hold it for one extra year.
Got it.
So that's a fourth year at that point in time. Now, I often kind of highlight the first holding period usually is pretty easy to hit.
Yeah, because you have vesting, right?
Exactly right. Yeah. So a lot of times you're not vesting all of these shares until a year later anyway. And so one of the 2 years, or sometimes it's 2 or 3 years later, the vesting may already push you beyond the grant date
Sure.
itself. Now let's say it vests in 1 year. You could, I'm gonna jump one slide real fast just to kind of highlight this. You it vests in 1 year in between here. You can exercise it there, but
Okay.
you have to still wait another year to satisfy the exercise one that's a full year. And at that point in time, you'd be 2 years from grant and 1 year from
1 year from
exercise.
exercise.
So it is possible that it's 2 years from grant and you actually get all this. It just depends on when everything vests, when you choose to make the exercise occur. The AMT, I've got a slide on that. We'll kind of capture that itself. One thing that is a little bit of a nuance, it doesn't happen all that often, but you cannot have more than $100,000 of ISO value. So basically, that spread that occurs be,
Okay.
or excuse me, the grant date fair market value. So your grant amount cannot be more than $100,000 in a single calendar year.
Got it.
And so this is really more on the company to regulate what they're giving you
Right.
at that point in time. And what ends up happening here is going back to kind of those 2 years. If I hold it 2 years from grant and an additional year from exercise, so the earliest year in this case is 3 years, then I get that better tax treatment. It's all long-term capital gains. So that entire
That
spread, because
entire spread. There's
yes,
no ordinary income in this example.
correct. If I have met both holding
Okay.
periods. If I do not, that's what's known as a disqualifying disposition. So you satisfy both. It's a qualifying disposition. The entire gain, fair market value from when you, well, actually, fair market value from when you sell it on the back end
Right.
to the strike price, all long-term capital gains. Disqualifying disposition, this basically just resets you back to what a non-qualified option is. You're going to pay ordinary income tax on that spread itself when you end up turning around and selling it. So what you could end up doing is you could, let's go back to our example of it was 20 to 80. If the stock price actually continued to go up, I can get all of it as long-term capital gains. Whereas on the non-qualified, it was 80 minus the 20 was ordinary income
Hmm.
and then some capital gains. I can get all of that as capital gains. Disqualifying if it continued to go up and I sell it, now it's just all ordinary income for me. And so from a tax perspective, I go back to the regular spread being ordinary income. I still could potentially have some capital gains. It can be challenging because you could potentially pay taxes on something using AMT
Okay.
and it go down in value as you actually pay
Got
some
it.
taxes.
So there's a little risk there.
There is a bit of risk, and this is the idea of kind of AMT or the tax trap that exists. So for those who are, I would say, uninitiated when it comes to AMT, alternative minimum tax is basically when your accountant preps your tax return for you. And
Hmm.
if you're subject to AMT, I would highly recommend having a qualified CPA do your taxes
Yeah.
because it makes a lot more sense to be able to kind of go through unpacking that yourself is a little more challenging. Your tax return basically gets prepped in two same fashions. Your normal tax return itself, and then there's an applied minimum tax rate that gets run. And if for some reason your ordinary income tax is lower than the alternative minimum tax, what gets filed and you pay taxes on is the
Is the
alternative minimum
EMT.
tax scenario. What ends up happening with incentive stock options is remember, we kind of highlighted when you exercise, it doesn't mean that the taxes are owed at that point in time. You're recognizing income but you're not paying taxes on it until the eventual sale
Right.
because you're trying to get that qualified period, the 1 year post exercise. Well, the IRS views it and says, hey, that's still income. We're going to put it in as a part of this AMT items.
Yep.
And so it's going to add income to your overall AMT side of the tax return. So there's two sides of tax returns. If you have not sold it yet, the income, that spread is included on the other side to check and see if you paid enough in taxes. That doesn't mean you're going to have that happen, but it can lead to this scenario where there's this tax trap. So hypothetically, you exercise something that's gone up quite a bit in value.
Yep.
A non-qualified, you pay the taxes that year and you're done. The ISO, you're not paying the taxes until you go to sell it. The spread here that's gone up in value, you turn around and you say, hey, I'm going to try to wait an extra year. That's going to be a part of that alternative minimum tax. And if I have taxes owed, I might pay them in the current
Through
year
AMT.
through AMT,
Got it.
despite the fact that I've not sold the shares yet. But if now the stock price has gone down, I've paid taxes on something that was not at the same value. If it went down between me paying the AMT taxes and when I eventually sold it,
Right.
I pay taxes on the higher amount. I'm not getting that all back as a credit just yet.
Okay.
So what you pay in that taxes, basically it has what's called a carry forward. So you get a credit to offset your AMT in the future, your alternative minimum tax itself. And then it allows you to recover most of that tax bill. Where it does not is if you see the stock price drop quite a bit, then you've paid higher taxes than you would have had you just straight up sold them outright.
Okay.
And so it can be a little bit daunting to kind of unpack this. This is where us or your financial advisor working with an accountant is really pertinent, making sure that we actually do the due diligence of modeling these different
Sure.
things together so that you kind of see the overall impact and we know, okay, in this year, we might have a little more in taxes, even though we didn't sell anything to be able to do so.
That brings up a question I was going to ask you. How does it get report? How does the qualifying versus um, you know, the non-qualifying disposition get actually recorded? Is that just on the CPA to record it?
Hmm.
Does the custodian actually kick off something that shows the holding period? And how do we keep track of this? How do we make sure this is reported
Yeah, so
correctly?
there's an AMT schedule that gets prepped with your
Okay.
tax return if you are subject to it that ends up coming into play that should be a couple of pages in as a supporting schedule to your tax return and it'll show on there. So on page 2 of the 1040, there is a line for like AMT tax. You'll have your regular tax and then there's
Got
AMT
it.
tax that'll come into play. That schedule, if you did pay alternative minimum tax, is what will also have that carry forward credit to offset a future tax year if you did end up paying that. Um, if you let's say that the stock price may potentially go down and you actually end up selling it, so you have a disqualifying disposition in the year, AMT doesn't really kind of come into play at that point in time because you're
Sure.
just reverting back to basically what a non-qualified is.
Got
You
it.
might still see the schedule prepped, but since it was disqualifying, it'll basically nullify a lot of it.
Got it.
And so, yeah, it is important to make sure that you're monitoring how that gets reported on the tax return so that you don't forget it. Because if I paid tax, this phantom tax, excuse me, this tax on phantom income, I want to make sure that I'm getting the credit in the
Yeah.
future years when I end up having higher taxes overall. And so there's a form 8801 that is what's going to track your carry forward every single year until you would take that credit and it would offset taxes in the future for you. So we walked through an example previously with Mike. We're going to look at an ISO example for Sarah in this case. And so 1,000 shares of ISOs, $10 strike, that hasn't changed. This is a little bit different. We've kind of bumped it to spread this a bit more and the dollar figures be a little bit different. Fair market value is 90. And Sarah has vested these. She has the option. She's exercising them now in what we're calling year one. We're assuming that we're at least a year later
Mm-hmm.
from the grant date at that point in time. So we have the same spread. Fair market value of 90 minus the $10 strike. So it's $80 times our 1,000 shares. It's $80,000 of income. The amazing thing is that year in year one, I don't pay any taxes. Sarah doesn't have taxes associated to her at that point in time.
Right.
Now, if she holds it for at least 1 year post the exercise, and it's 2 years from grant. So we're looking in year three at this point in time. So 2 years and a day, she sells it at 120. So normal non-qualified, I would have had my basis had been 90, and so
Right.
30 was capital gains, but I paid the 80,000 in year one. I got to punt my taxes on this for a couple of years until I actually ended up selling those shares. That year one scenario, we had some AMT taxes. So not all of the taxes got punted themselves. So again, if Sarah's in the 32% tax bracket, we would see $80,000 worth of taxes at 32. That's larger than what this 18.5 would have been.
Sure.
So we paid some taxes. But when we get to year three, we saw all 120,000. Now the difference between the 120,000 and the 10,000 that we paid for it, that's all long-term
Long-term
capital
capital
gains.
gains.
And so if Sarah's at the 20% capital gains bracket at that point in time, that's 22,000 versus what would have been 35,
Sure.
32, 35, 37 back in year one. So we got some deferral on the taxes being owed, and we paid less in taxes overall. Now, we simplified all these
Yeah.
scenarios. All these have been simplified a bit. We didn't include state taxes. We didn't include the FICA in the calculations overall or net investment income tax.
Hmm.
There's other taxes that kind of come into play overall, but for simplicity from a math perspective, we wanted to just focus on the federal tax bracket itself. And so this 22,000 of capital gains occurring in year three, you may have actually reduced some of it by the AMT credit coming back in year three when you ended up selling it
Right.
at that
So
point.
really a way to think about this too is because of the AMT credit and how that functions later down the road, once you have ISOs for a while and you
Yep.
and you have this AMT credit built up, it's less impactful. The AMT itself is less impactful. It's really
Exactly.
just that first, maybe second year.
Yeah.
Once you have the credit and the carry forward going, the AMT is not going to be
It,
as
it's
big of
it's
a
not
deal.
as impactful, yeah, at
Sure.
that point in time. Because if you routinely have AMT that you're subject to, a lot of times if you're selling the ISOs on a
Yeah,
routine basis, that credit's actually offsetting what that overall tax
exactly.
bill is. That's a good point. The only other thing that I'll kind of highlight, and this was a lot more common probably 10 years ago or so, is the question is, well, I really want the extra tax incentive here on an ISO, but I still have to come up with this strike price, right?
Hmm.
So how would this occur? A lot of times companies will grant you both non-qualified options and ISOs together.
Yep.
And so what employees would often do is we would kind of model things and we would do like a cash lift
Do a cashless
exercise.
exercise on the NQSOs.
Right, which gives me I've covered the taxes on those NQSOs, and I've got some shares that I can also sell now. If I sell those shares, I'm using them as my strike price payment on the
The
ISO.
ISOs. Okay.
So it allows me to basically liquidate some shares, but I get as much favorable tax treatment as possible, and then I hold on to those shares for an extra year because again, we've got to hit that second holding requirement of a year post
Sure.
exercise, and that's what allows you to pay the lowest amount of taxes possible on these shares themselves. So we covered a lot.
Yeah.
It's a lot more nuanced. I think we kind of highlighted that level one last month is more common. It's a lot cleaner from a tax perspective to be able to do so. In non-qualified options and ISOs, we've given control back to the employee. You
Exactly.
get the ability to kind of control your overall tax impact. How are we going to wrap this up next month?
So the last thing we're going to cover, webinar 3 next month, is we're going to cover employee stock purchase plans and ESOPs or employee what
Employee stock ownership.
ownership plans. Yeah. So these prior to we've covered, more often you see these for highly compensated employees or executives. These next two plans are a way for every employee
Yep. Yep.
to participate in the equity, in the ownership of their firm or their company,
That's right.
right? So these will be a little bit more straightforward, not as much as far as grant and strike and exercise. But I do feel like just this is a nuance, this is just anecdotal from my perspective. I'm seeing ESPPs be offered a lot more.
Yeah. Yeah, and there's definitely incentive that happens with them, but it's to your point, this is probably shifting more into the equity building side
Sure.
than it is the compensation side of things.
Hmm.
Restricted stock options are much more in the compensation in the current year. employee stock purchase plans and ESOPs that exist, that becomes a lot more of the equity building and buying into the
Right.
company that I'm a part of at that point in time in the future there.
So just to wrap this up, if you have, first of all, thanks for joining us on the
Absolutely.
day after
The day for
Memorial
Memorial Day.
Day.
Yeah.
So we appreciate that. And if you have any, these are very, very complex and specific to each client's own scenario. So if you
Absolutely.
have questions, or if you know anyone that has these and they might be asking you questions and you're not so sure, send them our way. We'd love to help
Yep.
dive in and just answer anything we can.
Absolutely. Yeah. Send them a link to the webinar. We'll send out the recording itself. Send them a link if they like what they see, and let them know that we'd be happy to kind of help model these scenarios and kind of walk through the decision making process when it comes to stock options, when to make them, how
Yep.
much concentration risk do you have, all the different components that come into play when it comes to equity compensation. And then next month we'll wrap this up and kind of talk about the employee stock purchase plans
Yep.
and ESOPs themselves. Until then, we hope you guys have a great rest of your week.
Thank you.
Thanks.